Okay, so let's start one more important chapter now, which is mergers, acquisition, and corporate restructuring. So, from exam point of view, this is also one of the important chapter. And this is chapter like wherever you go, this chapter follows you. You are in accounting, advanced accounting. You are going to taxation. You go to law. You have in SFM. You have in FR. Everywhere, this chapter is important. And because that by nature wise, this chapter is essential even in the practical life. So we'll not spend too much time on importance of this chapter and all. It is important. That is sufficient. So when you talk about merger, it's as good as it is a definite component in your life, like marriage, things coming together, people coming together. Now, corporate restructuring broadly can have two varieties. One, ownership structure gets changed. The other, operation structure is changed. So when you acquire a company by issuing shares, one type of settlement will take place, or you acquire a company by issuing cash. Your ownership is not changed, but the structure of the organization is changed. Internal reconstruction, where you don't change the ownership, but amount will be set off, restructuring will happen. So broadly, two varieties are there. Quickly, there are forms like acquisition, merger, demerger, and so on. These kind of problems also may be asked. But what is the main concept of mergers? Let's say you travel in an auto, you pay 100 rupees. You and your friend travel same distance, price will be same. So each of you can have only 50 rupees each now. So you save 50 rupees. If three people travel, you will be saving 33 rupees each. I mean, you will spend 33 rupees. You save 67 rupees. And if four people travel, I think autofill also will ask you more. Even traffic police also will get some amount. Everybody will get a share. That is what is called as economies of large scale operations. So when you produce more in a large scale, per unit cost will come down. That's what it says, synergy benefits. That is, every year your expense will be saved, saving in cost, saving in expenses. That's called as synergy benefits. So main purpose of merger is synergy benefit. So look for this information in the problems also. Rationale for merger, I will not spend time. It's important. That's all I can say. One term, due diligence, you would have heard of it earlier. Due diligence means when you acquire a company, organization, is there any issues involved in terms of taxation cases pending, legal cases, operation issues, management problems, employee issues, labor issues. So when you discuss those, when you do a detailed investigation of the issues involved, it's called as due diligence. A quick theoretical point. Anyway, types of merger, broadly four types are there. Horizontal merger means companies in the same industry, Vodafone, Idea. Vertical merger, you acquire your supplier or your customer. You are a company, you supply you are purchasing goods from raw material from one of your suppliers, and you thought instead of buying from them, let's acquire them. Typically, it can happen in automobile industry and all, where you acquire the component suppliers. That is vertical merger. In the component suppliers, the buyer seller relationship is there, though they get merged. Conglomerate merger, unrelated companies gets merged. Reverse merger, a smaller company takes over larger company for legal benefits, for tax benefits, and so on. Okay, so I've explained. Let me go further. Okay, from exam point of view, what we need to focus on is this: we will have two different terminology here. We'll always get confused in the sense, who is the buyer, who is the seller, amalgamated company, amalgamating company, vendor company, buying company. So terminologies are numerous. So let's stick to two particular names. I will call not buyer seller, not purchaser vendor, amalgamating. I don't call. I use the word acquirer, target. That is my simple, straightforward terminologies. Throughout this chapter, I will focus on these two terms. I don't use AB. They will use different name. Mani Ratnam. They give name. They give long latitude, long short. So they always confuse you with names also. But I will use these two standard names. Acquirer, person who is acquiring. Target, the company being acquired. So I'll use only these two terms for communication purpose, for consistency purpose. Okay. What and all to be learnt? In merger problems, essentially valuation is a byproduct. It's a main product only, I can say. Valuation is done. Why? For individual, for listed companies and all, you can say, okay, per share basis, we have to value. I want to trade. But if you think at a larger level, valuation typically comes when one person wants to acquire. Even if you're buying one share, you're acquiring one share, right? Now, if you think in a larger scale, valuation is necessity when it comes to mergers, because there is one important term which is used in amalgamation, business combination, merger, wherever it is, called as purchase consideration. How much amount to be paid to acquire a company? That is requiring valuation. And valuation is subjective. Thousands of ways valuation can be done. So I have summarized into examination perspective. Examination perspective only, I'm giving you this. What has come in the exam so far? One popular method. 90% of the merger problems is based on this. 90%. Was it 95%? Based on P ratio method. What is P ratio method? Value of the company is net profit into P ratio, or price per share basis, EPS into P ratio will give you MPS. Correct? Value of company. What is price earning ratio? For every 1 rupee earning, how much you are ready to pay? Price earnings. So if I say P ratio is 12, means for 1 rupee earnings you make, I will pay 12 rupees. That's what P ratio. Practically, we have difference of opinion, different methods are there. Valuation is a subjective element. But for exam purpose, for merger problems, most of the problems we will apply P ratio. So P ratio application means on net profit, when I apply, net profit to P ratio will give you value of company. Value of company, you can also call it as market cap. Market cap, market capitalization, market value. And if I apply for per share basis, what do you get? If it is per share basis, EPS, estimated earnings, multiplied by P ratio, valuation multiple, will give you expected market price per share. And this, if you do multiply by number of shares, also give you market cap. 95% of the merger problems are based on this concept. Some problem I've seen, dividend discount model. They'll give you information on dividend. You know formula what we do? D1 by K minus G. Or D0 into 1 plus G by K minus G. D1, dividend expected to be paid at the end of the year. K, cost of equity. G, growth rate in dividends. What is the logic behind formula? We have discussed during corporate valuation chapter. And sometime maybe based on cash flow. They'll give you cash flow for year 1, 2, 3, 4 and some 6 onwards. They said assume a constant growth rate. So we will use present value of cash flow and present value of terminal value. Hope you remember, where growth rate stabilizes, we calculate terminal value. Some problems are based on this, but as I told you, 90% of our focus will be on the based on PE ratio method. TV means terminal value. If you want, you can write a quick chart on this one. Okay, hope you've taken down. Hope it is done. Okay. Okay. Now, when you talk about valuation, that is purchase consideration, payment can be done in two ways. You can pay in cash, or you can pay it in shares, change in ownership interest. So when you pay by cash, you get the assets and liabilities of the company, and you pay the amount of cash purchase consideration. The existing ownership will not change. But when you issue shares, existing ownership will have a breakup, will have a change, because new people will join in your company, new shareholders will join in. But again, 90% of our problem is on issuing shares. I'll give you example also on issuing cash, but 90% of the cases are acquiring company by issuing shares. Okay. In that context, you have to understand one term called as swap ratio. Is also called as exchange ratio. Exchange ratio. It is interpreted differently, but normally we write like this. If I say A is to B, that means for every share held, or let me just write down swap ratio, write down meaning swap ratio. It is the number of shares issued by acquirer for every shares held in target limited, target company. Number of shares issued by acquirer for every share held in target limited. So swap ratio, exchange ratio, ER, SR is given by calculation of swap ratio. The ratio is calculated by, okay, sorry, before that, let's fulfill the sentence. It is the number of shares issued by acquirer for every share held in target based on parameters such as, based on parameters such as EPS, earning per share, MPS, market price per share, book value per share, etc. Or maybe combination of above. Sometimes they say swap ratio is based on earnings. Sometimes they say swap ratio is based on market price. Sometimes they say 50% weight for this, 50% weight for this. Weighted average also might be there. Okay. Now swap ratio is calculated by whatever the parameter we use. Parameter of target company. This is like purchase consideration issued by way of acquirer. So parameter of target divided by parameter of acquirer. Parameter of acquirer. Example, suppose MPS, sorry, EPS, okay, let's say based on EPS. EPS of acquirer, let's say 5 rupees, and EPS of target is 2 rupees. So how many shares will be issued? The ratio will be, swap ratio will be 2 shares divided by 5, means 0.4. So for every 1 share, you will be giving them 0.4 share. Does it make sense? They're having 1 share and they get only 0.4 share. They receive less. Yes, their earnings are less. Justified. Your earnings are less as compared to me, so you better get less number of shares. I will not give you full shares. I'll give you less number of shares because your earnings are less to make it comparable. Okay. If earnings of a target company was 5 and acquirer was 2, 5 by 2 becomes 2.5. There it makes sense because your earnings is more, you should get more number of shares. When you calculate number, apply a little bit of logic also. Anyway, 0.4 shares. Okay, number of shares, let's say. Number of shares of acquirer, let's say, happens to be 10,000. And target company number of shares happens to be, let's say, 1,000. Now, what is 0.4 means? For every 1 share held, 0.4 shares are issued. So if you want to calculate how many shares are issued, where will you multiply? Will you multiply with 10,000 or will you multiply with 1,000 to compute the number of shares issued? Because one of the common mistake people have done in this case. Obviously, it is for target company because for 1 share held, you get 0.4. You're having 1,000 shares held. How much? So it's not 10,000, it's on 1,000. So number of shares issued is calculated by number of shares issued is calculated by the swap ratio multiplied by number of shares of target company. Number of shares of target company. Now, number of shares issued by acquirer. So, if you broadly compare, you know what we did in foreign exchange chapter? When you applied the exchange rate, conversion rate, what happened? One currency got converted into another currency. US dollar 1,000 multiplied by 50, you got 50,000 rupees. So, when you apply the exchange rate, the other currency is obtained, right? Similarly, when you apply exchange ratio, other companies' shares are obtained. Number of shares of target company you have. You apply exchange ratio on that. What do you get? Other company shares, that is number of shares of acquirer is obtained. So for target company number of shares, apply swap ratio, you get number of shares of acquirer. Exchange ratio works like an exchange rate, converts number of shares of one company, the number of shares of target company into number of shares of acquirer company. Is it fine? Okay, one small point to be kept in mind. Typically, it comes in bank merger problems. But anyway, we'll do it later. But one point to be discussed. Suppose the parameter what they're looking at is bad debts of two companies. Bad debt ratio of two companies. So one company, the acquirer has debt ratio of let's say 10%, and target company has bad debts ratio of let's say 50%. 50% not able to collect. Now, if I apply this formula, what happens? Target by acquirer, target company bad debt ratio 50%, acquirer company bad debt ratio 10%. Now 50 by 10, 5 shares. Do you think it makes sense? A company having more bad debts, they get more number of shares, it seems. More earnings, you get more number of shares, justified. More market price, more number of shares you get, justified. Your value is more. But you're having more bad debts and you get more number of shares. Do you think that is justified? Definitely no. So in that case, the formula will be reverse. It becomes acquirer by target. So in which situation we need to apply this? Wherever the ratio lower the better. Higher ratio is not suggested. The ratio should be lower, like debt equity ratio, bad debt ratio, NPA for banks. Cost, we want them to have a lower ratio. When we prefer lower ratio, the better. In that case, the formula will be inversed. Write one small note. One small note. Please write down. Write down. Uh, when the ratio is lower, the better. When the ratio is lower, the better. When the ratio is lower, the better. For example, bad debts, NPA. When the ratio is lower, the better. For example, bad debts, NPA, debt equity ratio, etc. Debt equity ratio, etc. The swap ratio will be reversed. Swap ratio will be reversed, meaning it will be acquirer by target. Okay, in that case, swap ratio will be reversed. Swap ratio will be reversed. That is acquirer by target. Acquirer by target. We have to discuss one more point on this swap ratio, minimum exchange ratio, maximum exchange ratio. That will come to slightly later. I need to discuss some more points before I come to that stage. I'll come back to that slightly later. Okay, hope you got it. Swap ratio. Okay, let's understand the synergy now. Swap ratio is done. Let's understand about synergy now. Synergy benefits. How to calculate that? Suppose we have acquirer here and we have target and we have merged entity. Let's say we'll talk about earnings. Earnings of the acquirer, let's say 100 rupees on the standalone basis. Earnings of the target company, let's say 20 rupees. And merged company, when they come together due to savings in cost, it becomes 122. Now, this 100 plus 20 is 120. How come you're getting 122? That plus 2 what you're getting is called as synergy in earnings. Sometimes in the problem, we have to calculate synergy in earnings. Sometimes they'll give you, we have to calculate the earnings of merged entity. So let's write down synergy in earnings. Synergy in earnings means synergy in profits. You can also say PAT. How are we going to calculate? Earnings of merged entity, in this case 122, earnings of merged entity minus earnings of standalone, earnings of acquirer minus, within brackets I can say plus earnings of target. We can also say synergy in value, holdings, synergy in value, holdings. Same formula. Value of merged entity. Value means what? See, earnings means only 1 year you take. Value means present value, market price, market value. So value of merged entity minus separately value of acquirer. Value means present value. Value of acquirer plus the value because in financial management, value means we say present value only. So value of target, standalone basis, value of target. Okay. Sorry. Okay, so this is the basics of the synergy part and benefits. Then we have to understand what is the impact of merger. What is the impact of merger on acquirer? What is the impact of merger on target? What is the impact on their earnings? What is the impact on market price? We have to understand that. We'll do it. Let me just take one small numerical, not an illustration, not a question from material, but just give you the numbers. Then we'll understand the impact analysis. Along with that, we'll write the formula. Okay, one simple numerical will take, and this is a typical format they give in the examination also. They give you one column for acquirer, and they give you one column of target, and merged entity they will not give. We should calculate. They will not give merged entity. So acquirer, what they tell, for example, earnings of acquirer, let's say 1 lakh, and they'll give number of shares. Let's say it is 20,000. Target company, let's say they are having 10,000. And number of shares, let's say they have 10,000. Merged entity, earnings, let's say 1 lakh 12,000. For the time being, let's say, for the time being, no synergy. For the time being, no synergy. Let's say 1 lakh 10,000. 1 lakh 10,000. And P ratio they give, or they say market price per share. Market price per share, or let's say P ratio they give, whatever it is. Let's say P ratio of acquirer, let's say it is 12 times. Of target, let's say it is 6 times. Merged entity, assumed to be same. Normally, the acquirer P ratio assumed to be same. Assumed to be same as acquirer. Understanding what happened till here? Acquirer having a P ratio of 12. They have acquired target assumed to be same after acquisition also. This is the basic data given. Now what we need to calculate? Let's say swap ratio is based on earnings for simplicity's sake. Let's say swap ratio based on EPS. They have given swap ratio based on EPS. Simple verification, simple calculation. Okay. Now what and all we need to do here? First we need EPS calculation. How much EPS will be? They have given earnings. Divide by number of shares. 1 lakh divided by 20. You get 5 rupees. 10,000 by 10,000. You get 1 rupee. So EPS 5 and 1. So what is the swap ratio will be? Not 5:1. Swap ratio will not be 5:1. Swap ratio is Target by acquirer 1 by 5, which means zero point 0.2 is to 1. Zero point 0.2 shares for every 1 shares held. So how much will be number of shares issued then? Number of shares issued will be 10,000 target company into zero point 0.2, it becomes 2,000. Okay, so acquirer, target, merged. So EPS we have to calculate. Here we got it 5 rupees. Here we got 1 rupee. Here we have to calculate. Number of shares 20,000. Number of shares of target 10,000. But I cancel 10,000. In place of that, I write 2,000. Because 10,000 is replaced by 2,000. In the merged entity, it becomes 22,000. What is market price per share for our reference? What is earnings, total earnings if you want to calculate? Total earnings. Total earnings, 1 lakh here, 10,000 here. So we got 1 lakh 10,000. So what is going to be EPS of the merged entity? You also highlight like this: 1 lakh 10,000 divided by 22,000. You get 5 rupees. You get 5 rupees. You get 5 rupees. Okay, now in this example, let's see what is the impact of the earnings or impact of the merger on earnings of the two shareholders. Let's understand. Impact on earnings, impact of merger on earnings of shareholders. Okay, for the shareholders of acquirer, then I'll do for shareholder of target. Okay, so simple format I'll do, like what is their EPS after merger minus what is their EPS before merger. After, before, very simple. Before merger. So here also EPS after merger minus EPS before merger. Okay. Now for the for the acquired company shareholder, what is the EPS after merger we just calculated? It is 5 rupees. What is the merger EPS after before merger? It is 5 rupees. It was 5 rupees, right? After merger also 5 rupees. Therefore, it is 0. 1. Okay. Now 0. No impact. No impact. No impact. Now this EPS before merger of target share of target company was how much? Target company before merger, the target company's EPS was 1 rupee. Was 1 rupee. Now, 1 rupee became 5 rupees. Are they gaining 4 rupees? Is it correct? Definitely not right. What is the mistake here? Correct. Number of shares are of different companies. Number of shares are not comparable. So for target company shareholder, before merger, if you had one share, after merger you will not have one share. Before merger, if you had one share, after merger, how many shares you will have? I'm asking per share basis. I'm not asking total number of shares. Before merger, you had one share. After merger, you will have just zero point 0.2 shares. Therefore, you should not take 5 rupees entirely. You should take 5 multiplied by zero point 0.2. Therefore, that will give you EPS of 1. So before merger is also 1. After merger is also 1 for the shareholder. So again 0. No impact. No impact. No impact. So what we should do when you're calculating EPS after merger, especially for target shareholder, please remember the formula is EPS of merged entity, EPS of merged entity multiplied by swap ratio, multiplied by swap ratio, multiplied by swap ratio. So and this is called as equivalent EPS. This is called as equivalent EPS. Equivalent EPS. So when you calculate for a target company shareholder, you should not just take EPS. The same rule applicable for market price per share also. Okay, it is equivalent EPS. Okay, now why are we having no impact? The reason for no impact are two reasons. No impact because of two reasons. No impact because two things. Swap ratio is based on EPS, so earnings was not affected. Swap ratio based on EPS. One more reason is there. One more reason. No synergy benefit here. So nobody is getting anything extra. If there was synergy benefit, EPS would have increased. Hope you understand. If there was synergy benefit, EPS would have increased. So whenever swap ratio is based on EPS, do you think the earnings will remain same? Yes, provided no synergy benefit. If synergy benefit is there, even when swap ratio is based on EPS, the EPS will not remain same. When there is synergy benefit, there will be impact of earnings. Hope you got this one. Just 1 second. Okay. 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 Now same thing. Just give me the data points once more. Let me just repeat it. Just lost it. So what data we had in this problem? I'll do slightly differently. Same acquirer, target, number of shares we had is, let's say, how much was that number of shares? 20,000 and 10,000. And earnings were 1 lakh and 10,000. So EPS was 5 rupees, 1 rupee. P ratio, how much I had given? 12 and 6. Okay, well, let's do one thing. Just make a small change. Make it as 12 and 12. P ratio, please make it as 12 and 12. Make it as 12 and 12. Equal for simplicity. So what will be market price will become? I would just like to do now. Let's say if swap ratio is based on market price. I made the change, make P ratio both as 12 only. I made the change. Make it as 12 12 for discussion purpose. If swap ratio based on MPS based on market price per share. So how much will be MPS now? EPS into P ratio. Oh, you get the same answer, no? When you do it also multiplied by same P ratio. Okay, let me take a different number here. It was 6. Okay, let me take, I'm sorry. I'll keep it as 6 only. I'll keep it as 6 only. Let's see what happens. I'll keep it as 6 only. Market price per share equals, in the case, 12 into 5 becomes 60 rupees and 6 into 1 becomes 10 rupees. Correct? Becomes 60 rupees and 10 rupees. So what is the swap ratio is going to be? Sorry, 6 rupees, no? 6 into 1 becomes 6 rupees. I'm sorry. EPS into P ratio gives you market price. So 6 into 1, 6 rupees. Swap ratio, 6 by 60, which is equal to 0.1. So number of shares issued will be how much now? Number of shares issued, 10,000 into zero point 0.1, point is to 1, point 1 is to 1. So 10,000 into zero point 0.1, you issue only 1,000 shares. Issue only 1,000 shares. What is going to be the EPS of merged entity? EPS of merged entity. Earnings was 1 lakh plus 10,000, 1 lakh 10,000, whole divided by how many shares? You had existing 20,000 shares plus you issued 1,000 shares. So 1 lakh 10,000 is the earnings of the merged entity and 21,000 is the share EPS of the merged entity. Five point two three, 5.24, right? Let's say 5.24. Okay. For this also, let me do the impact on earnings. Impact on earnings. Impact on earnings. For target company shareholder, let's say first acquirer company shareholder, and for target company shareholder. After, before, that's it, very simple. So after merger, it is 5.24. Before merger, it was 5. So they have got a gain of 0.24. Whereas target company shareholder, before merger was 1 rupee. After merger, do you get 5.24? You don't get 5.24. You get 5.24 multiplied by swap ratio 0.1, equivalent EPS. Equivalent EPS. So what do you get? 5.24 into 0.1 minus 1, you get minus 0.476, right? You lose 0.476. Or let's say round it off, 0.48 I'll make. And just for verification purpose, see, one person is losing, other person is gaining, right? Because the swap ratio is not based on EPS. One person winning, other person losing. How much is that? You can verify. How many shares are there for 0.24 if you want to do overall total number of shares basis? The gain is not equal to loss because of the number of shares. I'm showing it to you. 0.24 is for how many shares? Number of shares, 20,000. And minus 0.48 is for how many shares? 10,000. Multiply. So you get total gain of 4,800, and here you have a total loss of 4,800. One person's profit is other person's loss because no synergy benefit here. No synergy benefit here. So overall, one company's gain is equal to another company loss. Shareholders of one company, shareholders of other company. Shareholders of one company gain is shareholder of another company loss. Okay. Now similarly, if you want to calculate impact on market price, what you would have done, I'll give you formula. We have to do some calculations also on that. We'll come to that, but wait for a second. Now, okay. Hope you got these calculations. How the impact will be there. Okay. Now, one more small situation, and then we'll give you all the formulas, and then we can go for problems. May not in this session, another session, but let me just give you the idea. Now, I would like to go back to a little bit of swap ratio concept because that kind of problem may be asked relevant for this. Okay, I'm going back slightly to swap ratio part. Swap ratio. Okay, we are having two kinds of shareholder. One is acquirer shareholder and target company shareholder. Okay, Now, please tell me, acquirer is the buyer here and target company is the seller here. Now, I would like to ask you, I would like to discuss with you what is the maximum ratio possible, what is the minimum ratio possible. Okay, now you are a buyer. Now tell me, what is the minimum ratio you want to pay? Given a choice, what is the minimum you want to pay? Given a choice to you, you are an acquirer, what is the minimum you would like to pay? It's like this. You want to buy a mobile phone. What is the minimum you want to pay? Zero, definitely, right? Minimum ratio is zero. You don't want to pay anything. You want free. Everything you want free. Zero. Now, tell me from a seller point of view, what is his maximum ratio? What would be his maximum? Seller wants. Seller receives. How much maximum he wants? If you are selling something, or if I ask you like salary, how much salary you want? As high as possible, infinite, not cost plus profit. That is minimum you require. Maximum how much you require? You want as many as possible. I'm asking maximum sales price, as many as possible. So this is infinite. So those two things will not be asked in the problem. If at all we discuss what is the maximum ratio for a buyer can be asked, what is the minimum ratio for a target shareholder can be asked. They will not ask minimum ratio for acquirer. We know it's zero. They will not ask the maximum ratio for the seller because we know it's infinite. So the answer will only be these two cases. They will ask maximum ratio for the acquirer, minimum ratio for the target. Okay, now you are acquirer of a company. How much maximum do you think you are ready to pay? From a shareholder perspective, the shareholder will tell like this: you pay whatever you want, but but please don't make my holdings lose. As long as my holdings don't lose, you want how many ever ratio, you go and pay it. Are you understanding? From a tag acquire company shareholder, what they will take? I am your shareholder. What they will tell? You do whatever, how many ever shares you want issue. My existing position should not be touched. As long as I am getting a profit, it's okay. But my existing value should not go down. Now, existing value means what? Should I look at earnings based or should I look at holdings based? Which one do you think is going to be recommended? Which one is going to be there? Both fine. That depends on what is their problem. You can't say earnings based, you can't say market price based. It can be either earnings based or holdings based. But in fact, when nothing is specified in the question, when they ask you impact on holdings, we always go for a holding based, because what is the objective of financial management? To maximize not profits, wealth maximization. So let me just give you the formula for that and then I'll come back to this. So impacts of merger, impact of merger on earnings, or it may be on holdings. Impact of merger on earnings, or it may be on holdings. If it is on earnings, for target company shareholder, how do you do? For target company shareholder, you do like this. That is EPS after merger minus EPS before merger. That is impact. I'm just switching between these two. For acquirer company shareholder, Sorry, I wrote wrongly. For acquire company shareholder, first I should have written acquirer. For acquirer company shareholder, second one for target company shareholder. For target company shareholder, I'll write different color here so you remember. EPS before merger is fine, but EPS after merger should be equivalent EPS. So EPS after merger multiplied by swap ratio and minus EPS before merger. This is earnings based. What will I do if it is market price based? What will be the formula? On holdings, everything same. Instead of EPS, you replace it by MPS. That's all. So for acquirer shareholder, it is same thing, but you make it as market price. Market price after merger minus market price before merger. But for target company shareholder, you should not just take market price. What you should take? Market price of merged entity, and after merger means of merged entity. Market price of merged entity, market price after merger, market price after merger, what? Multiplied by market price after merger multiplied by swap ratio minus market price before merger. Before mergers. So whenever you come to target company shareholder, you should make sure that it is after applying swap ratio. Whenever it comes to target company shareholder, swap ratio to be applied. Okay. Now coming back to swap ratio, maximum minimum we are discussing. In the question they might say EPS to be maintained, or they might say MPS to be maintained. So when they say swap ratio minimum maximum, they should tell you from what point of view. Maximum swap ratio, keeping from the holding point of view or earnings point of view. Even in the problems, when they say swap ratio or when they say impact on holdings or impact of a merger, should be on earnings or should be on holdings. But when nothing is specified, listen to me, impact of merger by default, when nothing is specified, we go with holdings. This is presumed default. So this is presumed. Okay, just write it out space. If nothing is specified, on holdings is applied. If nothing is specified, on holdings is applied. If nothing is specified, on holdings is applied. Okay. Today I'll just extend the class by 5 minutes because I just want to give one more small formula. We are not solving any problem at this point, but just okay. Okay, so I'll go to the next one. Hope you have taken down till here. Uh, Maximum exchange ratio for the acquirer. What we should do? Maximum exchange rate means he should not be unaffected, he should be indifferent, meaning market price before merger should be market price after merger. Market price after merger. Here equivalent will not come. Market price before merger, that will be given. Market price of the whatever acquirer, that is before merger, market price of acquirer Market price of after merger, how do we calculate? We calculate by EPS multiplied by P ratio. EPS of what entity? EPS of merged entity multiplied by P ratio of merged. And usually we assume the P ratio of the acquirer assumed to be merged also. We usually assume. So P ratio of acquirer usually, or whatever is different number they should give. Of acquirer I'll take it. And how do we calculate EPS of the merged entity? Earnings of the merged entity. What is earnings of the merged entity? Will be earnings of target, earnings of acquirer plus earnings of target plus what? Plus synergy. Correct? So this will give you the earnings of the merged entity. Earnings of the acquirer plus earnings of the target plus synergy benefit if any. Whole divided by number of shares. What number of shares? Existing number of shares of acquirer plus, can you tell me how do we do for the target company shares? Number of shares of target. But I cannot take target company shares as it is. I have to multiply it by swap ratio. Target company shares multiplied by swap ratio. This is number of shares denominator, earnings numerator multiplied by P ratio. You should not remember this formula by heart. You have to remember conceptually, because remembering this is too much. Concept to remember, it is not at all a difficult thing. So this swap ratio need to be calculated. This swap is the maximum exchange ratio. Okay. What is a minimum exchange ratio? Same formula, one small change will happen. Can you think what would be that? Minimum exchange ratio, ERL, right? Minimum exchange ratio for target. Same formula applies. One small thing will be there. Not EPS. We are not looking at EPS. I'm looking at MPS only. The same concept you can apply for EPS separately. Same EPS before merger will apply. Sorry, MPS before merger minus MP should be equal to MPS after merger of merged entity. MPS after merger. One small thing will come. Same formula like this. Can you think what could be that? I cannot compare directly like this for target company. Why? Because they don't get one full share. They have to be multiplied with swap ratio. Same formula like previous one. MPS before merger, after merger, same formula applies, but the swap ratio must be multiplied in the numerator. The MPS after merger is multiplied by swap ratio. Then they become equivalent market price per share. They become comparable. It's the same thing. If they say EPS to be maintained, EPS to be maintained. If they tell so. Okay, so these are the formulas we have. Few more small points are there. I would like to bring it in one place also. Okay, so moving on with respect to the mergers. So what we just discussed now, discussed so far is regarding the impact of merger on holdings. You're not able to see the video. I don't know what is the problem. Screen not visible. Somebody is saying audio not, video not there. Somebody says screen not visible. Screen, I just shared a blank PPT. I've not written anything on that. It's a blank PPT now, as of now. It's a blank PPT, that's all. I'm able to write something. Okay, correct. Fine. So we were understanding about the concept of mergers, impact of merger on holdings, impact of merger on earnings. And when nothing is specified, we have to understand the impact on holdings always, because objective of financial management, we talk about holdings, that is wealth maximization, not earnings maximization. Unless they say specifically, we usually go for holdings as the analysis for impact of merger. We also understood the concept of minimum exchange ratio, maximum exchange ratio. It can be taught from both the point of view, but typically when we discuss from a acquirer point of view, we only look at the maximum exchange ratio because minimum is always zero. From the target company point of view, they always look for minimum exchange ratio because for them maximum is always infinite. Okay, now in this context, we have to understand one or two more small things before we go further. Let's quickly look at that. It's called as the cost of merger. Cost of merger. You see, acquirer company pays some amount to the target company. In your accounting terminology, you know what is it called as? Amount paid to acquire a target company. The amount is called as purchase consideration. Screen not shared. Are you not able to see what I'm writing? Okay, I have shared. I'll just do it once more. Okay. 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 So we are discussing about cost of merger. Acquirer has to pay some amount to target. In accounting terminology, that's called as PC, amount payable, purchase consideration. Exact same thing in terms of the SFM, that is called as the cost of merger. Cost of merger. So basically, it is the cost for the acquirer and benefit for the target target company. Okay, not exactly PC, but basically the benefit received. The cost of merger for the acquirer is the benefit received by the targets. So we use the term. I mean, yeah, PC will be paid. You can say that. That's fine. Acquirer will pay some amount that is called as purchase consideration. That is fine. The cost from the acquirer point of view, I mean, from the acquirer point of view, it's called as the cost of merger. From the target point of view, it's called as the benefit. Benefit, yeah. For the target, it is benefit. The company who's receiving, it's called as the benefit, and for acquirer, it is the cost of the merger. So basically, what benefit received by the target company shareholder is called as the cost for the acquirer. Let us write down in sentences. The benefit received by shareholders of target is the cost of merger for issuer, in the sense for acquirer. And broadly, there are two types. Broadly, there are, let's say, two types. One is called as the true cost, which is asked in exam also few times. True cost of merger. And the other one is called as apparent cost of merger, visible on the face of it. Apparent cost of merger. Okay, so I'll give you this formula. Let us see if you are able to remember anything out of this. True cost of merger is given by MPS merged entity, basically after merger, multiplied by swap ratio minus MPS of target company multiplied by number of shares. Number of shares of target company. Okay. Number of shares of target. Now, please tell me here, have you seen this formula anywhere earlier? We just discussed so far. MPS of merged entity minus MPS of target. MPS of merged entity into swap ratio minus MPS of target. Isn't it? That's what we calculated. The benefit of merger, impact of merger on a on the shareholders of target company. That's what we just discussed previous to this discussion. That's what is cost of merger. That's what I told you. The benefit for the target company is the cost for the acquirer. And when we say cost of merger, we don't express in per share basis. We multiplied by number of shares of target. That's it. So why it is called as true cost of merger? Because the market price of merged entity is considered. Market price of merged entity, because that is after merger, what will be the price of the entity and what benefit you get after mergers. But apparent cost of merger, it is visible. Then what you do, as a target company shareholder, you think some company is acquiring your company. Okay, you are a shareholder of steel company. Tata Steel is acquiring you, and their share price is 400 rupees, and they will tell you swap ratio is 0.5 is to 1. Now, on the date of acquisition, how does it look like? What do you think you get the amount? I'll tell you the facts once more. You are a target company shareholder, steel company. Tata Steel is acquiring you, and their Tata Steel share price is 400 rupees. And they're giving you swap ratio of 0.5 is to 1. That means for every one share, you get 0.5 shares. And every zero point 0.5 share is worth how much? The Tata Steel share price is 400 rupees. So you'll have zero point 0.5 share on a proportionate basis. 0.5 share into 400. So you feel like, oh, I think I'll get 200 rupees. That's what appears to be. But the true cost is not like the true benefit is not that. Why? Because after merger, the 400 will not remain 400. 400 may increase, may decrease, other things remaining same. Because we know we have to calculate, assuming P ratio remaining same, or EPS after merged entity multiplied by the P ratio will give you the revised market price. That will be the correct market price for your benefit analysis after merger. But on the face of it, when you look at it, it appears, oh, their share price becomes my share, and the share into swap ratio will be my income or my worth of holdings. It appears. So instead of market price of merged entity, you just take before merger. In the sense, if I take market price of acquirer into swap ratio, other things are same, minus MPS of target multiplied by number of shares, multiplied by number of shares are target, same. So everything is same. Only difference is here we take market price of merged entity because that is the true cost, true benefit. After merger, whatever the market price, that is what you get. But before merger, being a shareholder, what does it look like? You just look at the share price of the company. So market price of acquirer, that is apparent cost. That appears to be the cost for the acquirer is the cost. For the shareholder, it's the benefit. For the target company shareholder, it's the benefit. Okay, hope it's fine. Okay, I'll go further. Now, what we discussed earlier, to maintain we have computed like a maximum exchange ratio, minimum exchange ratio to maintain market price per share. It can also be to maintain earnings. But one more small point to be kept in mind. Let us just recap. When you talk about the purchase consideration, amount of consideration paid, amount of consideration paid by share or settled by share. Settled by shares. Then, from the acquirer point of view, what we discussed. From the acquirer point of view, if they want to maintain EPS or if they want to maintain MPS, whatever may be the case, suppose to maintain same EPS, let's say same earnings, what is the maximum exchange ratio to be given? Remember, how did we calculate that? Maximum exchange ratio. I would have given formula for to maintain MPS. Very similar if you want to maintain EPS. How do you write EPS before merger? That is EPS of acquirer should be equal to EP earnings of merged entity. What will be earnings of merged entity? Earnings of acquirer plus earnings of target plus the any synergy benefits whole divided by whole divided by number of shares of merged entity. How do you calculate number of shares of merged entity? Number of shares of acquirer plus the number of shares issued. And how do you calculate number of shares issued? Number of shares issued is going to be calculated by number of shares of acquirer plus the number of shares issued. And how do you calculate number of shares issued? Number of shares of target multiplied by what? The swap ratio, exchange ratio, and that's what we have to calculate. Swap ratio. And if it was to maintain MPS, then MPS of acquirer, same formula multiplied by P ratio. That would be to maintain MPS. Now, if the amount of consideration is paid by or settled by, not shares, if it is settled by cash, if it is settled by cash, then what will be the formula? Same, if I have to maintain EPS, to maintain same EPS, how will you calculate? Same, earnings of the acquirer plus earnings of the target plus synergy benefit divided by number of acquirer. Do you think this division will come? This number of shares of target, will it come into swap ratio? Will it come or will it not come? If you settle the amount by cash in the merged entity, will the new number of shares come into picture? It will not. Number of shares of acquirer only will be there because you issued by cash. You don't issue shares. You give cash. But because if you want to acquire, you might have taken loan partially or full amounts. So you will need to consider one more element. What is that? When you take a loan, you have to pay interest cost. That we have to take into consideration. So to maintain same EPC, to maintain same EPS, to maintain same EPS, if you take a loan, you have to pay interest. So I'll just write it in the big formula here. It will be earnings. Again, same thing. EPS of acquirer that is basically before merger should be equal to earnings of acquirer plus earnings of target plus synergy benefits. All these things are fine. And minus interest cost. Minus interest cost. I did not have a space, so I've written above. You can write continuously minus interest cost. And remember, all these earnings are after benefits. So after tax benefits, I mean after tax cost, would have done, these are all PAT. Earnings means PAT. But interest cost might be before tax. So here to convert into after tax, interest should be multiplied by 1 minus T. Since all these are PAT, all these are after tax. Interest also should be after tax. So multiplied by 1 minus t whole divided by only number of shares of acquirer, because their shares remain same. Number of shares of acquirer. Number of shares of acquirer. They might ask you how much loan to be taken so that EPS remains same. Something like that they can ask. But concept of swap ratio comes only when you settle by shares. And 90% of our problem, 95% will be based only on that. But one or two problem may be there. So I'm just giving you this idea, concept. If settlement happens by cash basis, purchase consideration paid by cash basis, then to maintain same EPS, they should also consider the impact of interest. And in number of shares, the acquirer's number of shares remains same. No question of shares issue. Okay. Hope we are clear till here. Any questions? Why don't we consider interest cost in settlement by share? Because there is no interest. When you settle by shares, you don't require loan. You don't need cash. You issue shares. So in settlement by cash, you might take loan. So when you take loan, you might have interest cost. Settlement by shares, why will you take loan? You just issue the shares. No loan, no interest cost. Synergy may have existed in settlement of shares also. Yes, synergy may have existed. But why are we talking about interest cost? Synergy I have taken in both the places. That's why considering synergy, earnings will be recalculated. But why I'm considering interest? Because of the loan taken to settle the amount, to settle the purchase consideration. Here, I'm acquiring the shares by issuing the shares. Where is loan? Interest will come only if there is loan, interest cost. Only if the acquirer takes a loan. In settlement by share, the question of taking loan does not arise. Okay? Good. Let's go further.